Tillis. Senator Warren is recognized for 5 minutes.
Thank you, Madam Chairman. Before I dive into my questions, I'd like to briefly address the ethical standards to which we hold our government officials. Mr. Barr, you're nominated to serve as one of the nation's most powerful regulators. Ethics rules require you to divest your holdings in stocks and other investments, which include investments in at least half a dozen crypto-related companies, if you are confirmed. But I previously asked you if you would go further and make the same historic ethics commitments that several other Fed nominees have made. Will you commit not to seek employment or compensation, including as a result of board service, from any company that has a matter before the Fed or any financial services company for 4 years after you leave government service?
Thank you, Senator Warner. Yes, I have committed to doing that, and I will do that.
I very much appreciate that. These commitments are important because one of the key challenges that all three of you will face, if confirmed, is crypto. Last week, the cryptocurrency market tanked again. The latest crash was triggered by a run on Terra, until recently the third largest so-called stablecoin by market cap. Turns out it was not so stable. If you put $1,000 into Terra USD 10 days ago, while it was still being promoted as a safe bet, today you'd get $90 back. And Terra isn't alone. $1,000 invested in Bitcoin in November would be worth $438 today. In fact, the average investor who put money into this can't-miss investment since last fall is underwater, a fact that the celebrity endorsers seem to have skipped over. But let's talk about who really lost money. Not the rich folks, not the insiders. No, it's ordinary investors. Online investor forums have been flooded with harrowing posts by people who feel they have nothing left and no way out, some with their life savings wiped out. It smells a lot like 2008. So what I'd like to do is run through protections for ordinary investors in the crypto market and how they compare to protection in other financial markets. So, Mr. Barr, if I can, let's start with you. If I bought a company's stock, even the most hyped up, junkiest one listed on the New York Stock Exchange, could I be reasonably confident that the company is following basic rules that protect against fraud, insider trading, and sloppy cybersecurity protocols?
Thank you, Senator Warren. The area of jurisdiction obviously is within the expertise of the SEC, but I think that is a reasonable basis for concluding that.
Okay, so there would be that protection because right now, stablecoin and crypto token users aren't getting that same protection. Now, some stablecoin boosters claim they're safe because their stablecoins are backed by real assets like treasuries and cash, not fake tokens and an algorithm. But during last week's market turmoil, Tether, the world's largest stablecoin market cap, broke its dollar peg. And that was scary because it's an open secret that Tether is not actually backed one-to-one by treasuries and cash like it claims. So, Mr. Lizarga, let me turn to you. If you invested in a money market fund, would you generally have confidence that the fund was actually backed by the liquid, high-quality assets that it claimed it was?
Thank you, Senator. Yes, SEC rules require money market funds to disclose their assets and to have those disclosures audited by independent third parties.
All right, and now let's compare that to stablecoins. Are stablecoins currently providing audited disclosures that allow verification that they're backed by quality assets?
To the best of my knowledge, no.
No. And in fact, asked why they wouldn't produce audited financial disclosures, Tether's executive said it's because they don't want to spill their, quote, secret sauce. I believe them. Tether doesn't want investors to know what is and what is not backing up this so-called stable coin. And that is a gigantic red flag. So I'm going to do this really fast. Let me do one more. Mr. Ueda, if you wanted to buy stock for a company listed on the New York Stock Exchange, could you be reasonably confident that the exchange wasn't trading against you or had other conflicts of interest that could put you at a disadvantage?
Yes, exchanges have to have policies to mitigate or eliminate any conflicts of interest.
Okay, very much unlike what happens in stablecoins. So, any investment involves risk. That's how markets work. But a market without rules is theft. And right now, regular investors in stablecoins and crypto aren't getting the baseline protections available in other financial markets. Count the ways that consumers can be cheated. No basic protections to protect against fraud, no review of cybersecurity, no audited financial disclosures, no protection against conflicts of interest, no cop on the beat to police market manipulation. There's not even any assurance that the other person on the end of a transaction isn't a terrorist, a money launderer, or a Russian oligarch on the sanctioned list. I understand the three of you may differ on how to regulate the crypto market, but addressing these kinds of risks will be your responsibility. So while Congress is working to set up guardrails on crypto, I urge you to use the tools you already have at your disposal to protect investors, to protect our financial system, and to protect our economy overall. Thank you.
Thank you, Senator Warren. Senator Kennedy is recognized for 5 minutes.
Thank you, Madam Chair.